All right, let's get into it. Today, we're going to peel back the layers on quantitative trading. We're going to push past all that confusing jargon and show you the clear, logical blueprint that powers some of the most advanced financial systems on Earth. So let's kick things off by looking at the massive shift that made all of this happen in the first place. For decades, the classic image of a trader was this person running on pure instinct, a gut feeling for the market. But the real question today is, can that gut feeling really compete with a system that's crunching millions of data points every single second? And this isn't some academic debate, it's the core challenge that has completely remade modern finance. And for a huge and growing slice of the financial world, the answer is a hard no. The speed and the sheer complexity of today's markets, it just makes pure intuition obsolete. The solution isn't to guess better, it's to build a better system, one that's written in code, that's repeatable, and that you can test against the cold, hard facts of market history. So here's our game plan for today. We'll start with that big showdown, human intuition versus the algorithm. Then, we'll nail down the super important difference between an investor and a trader before we start putting together the quant trading blueprint, piece by piece. After that, we'll see how these systems actually find an edge in all the market noise, learn the critical rules for surviving the inevitable storms, and finally, we'll think about what this calculated future really looks like. Okay, first things first. Why did this massive shift even happen? Why have algorithms and these systematic approaches just taken over finance? Let's break it down. The thing to remember here is that firms aren't doing this just to look cool and high-tech. They're doing it because the advantages are huge. A quantitative system gives you more predictable performance, it can find profits in all sorts of different unrelated strategies, and it can scale up in a way that no human team could even dream of. But honestly, that last point, that's the real game changer. Every single idea can be brutally tested against decades of data before one real dollar is ever put on the line. It turns trading from an art into a science. Now, before we really get into the nuts and bolts of these systems, we've got to make a distinction that changes everything. See, an investor and a trader are playing two completely different games, and understanding that is key to everything that follows. This slide just nails the divide, doesn't it? The investor is in it for the long haul. We're talking years, even decades, trying to build wealth slowly by figuring out what a company is fundamentally worth. But a trader, and that's our focus here, they live in the short term. Minutes, days, maybe weeks. They're hunting for lots of smaller profits based on price patterns and market behavior. And this table digs in even deeper. Just look at the risk posture row. An investor can just ride out a market downturn. But a trader, whose tiny statistical edge could vanish in a blink, needs instant, automatic, no excuses risk management. That absolute need for control is exactly why quantitative methods aren't just a good idea for trading. They're basically a requirement. Okay, let's keep it moving. It's time to actually look under the hood and dissect the architecture of these systems. And you'll see it's far from some magical black box. Every successful quant operation is built on a solid, repeatable engineering framework. And that framework rests on these four essential pillars. First up is strategy development. This is the aha moment, the idea about some little inefficiency in the market. Quants call this finding alpha. Second, you backtest the heck out of that idea. Third, you build a system to execute it perfectly, without emotion. And finally, like a shield around the whole thing, you have risk management. If any one of these pillars fails, the whole thing comes crashing down. Now, what's really fascinating here is the sheer scientific discipline you need. It is shockingly easy to trick yourself with data. Data snooping is when you basically torture the data until it confesses to anything you want. So it fits the past perfectly but has zero predictive power. Survivorship bias is when you forget to include all the companies that went bust in your test, which makes your results look way, way better than they really are. Getting any of this wrong is how a foolproof system blows up the second it touches the real market. So we have the architecture, but what are these systems actually looking for? Let's get into the core strategies, the playbooks that quants use to find that quantifiable edge in the middle of all the market chaos. Maybe the most intuitive idea of all is mean reversion. The concept is super simple. Prices can't get too far away from their real value forever. So when a stock's price shoots way up or way down from its long-term average for no good reason, a mean reversion strategy basically bets that it's going to snap back, just like a rubber band. And then on the total opposite end of the spectrum, you've got trend following, sometimes called momentum. This strategy works on the idea of inertia, that an object in motion tends to stay in motion. The system is brutally simple and disciplined. Buy stuff that's going up, and sell stuff that's going down. That's it. And then we have statistical arbitrage. You can think of this as mean reversion on steroids. It's the institutional supercharged version. So instead of just betting on one stock returning to its average, you find two assets that historically move together, like Coke and Pepsi. If that relationship temporarily breaks, like Coke stock zigs when Pepsi zags, the algorithm instantly buys one and sells the other, betting not on either company, but just on their historical relationship snapping back into place. This table just lays it all out so clearly. You can see how each one is built on a totally different core belief about how markets work. Mean reversion believes prices come back. Trend following believes they keep going. And statistical arbitrage believes the relationship between prices comes back. Understanding which game you're playing is everything, because as that key risk column shows, your core belief is also your greatest weakness. This brings us to what is, I would argue, the most important pillar of them all. You can have the most genius strategy in the world, but without rock-solid, non-negotiable risk management, it is completely worthless. This is all about one thing: surviving to trade another day. And this quote from the source material just says it all. When you hear about these quant funds blowing up in spectacular fashion, it's almost never because their main idea was wrong. Nope, it's almost always a failure of risk control. They might be right 99% of the time, but risk management is what saves you from getting completely wiped out on that 1% day. So how do you actually measure that risk? A huge tool for this is called value at risk, or VAR. Think of it like a daily risk budget. This number, just over 1/3%, means the system is designed so that on 95 out of every 100 trading days, the losses are expected to stay inside that limit. It's a clear line in the sand for what a normal bad day is supposed to look like. Another critical number is the maximum drawdown. Now, this isn't a probability, it's a historical fact. It's the single biggest gut punch your strategy has ever taken, from its absolute highest point to its lowest. And why does this matter so much? Because it's a raw measure of your system's pain tolerance. Quants are obsessed with keeping this number low, because protecting your capital when things go wrong is always priority number one. And the reason risk management is so tricky is that financial markets are, well, they're wild. They are not neat and tidy. Returns don't follow a pretty little bell curve. They have what are called heavy tails, which means those crazy once-in-a-century events happen way more often than you'd think. And you get volatility clusters, where quiet periods are followed by more quiet and chaotic periods are followed by more chaos. This is why you need really sophisticated tools, like the Armitage models, that are built specifically to understand that after a storm, the seas are probably going to stay choppy for a while. So, after we've built the blueprint, looked at the strategies, and layered on all the risk controls, what's the big takeaway? What does this all really mean at the end of the day? It all boils down to this. The entire field of quantitative trading is a systematic effort to replace our flawed human psychology, our fear, our greed, our gut feelings, with a process built on mathematical rigor and absolute unwavering discipline. It's about building a machine that can execute a good idea flawlessly, again and again, without ever getting emotional about it. And that leaves us with one final, pretty fascinating question to think about. As these systems start to incorporate machine learning and get even smarter and more adaptive, what happens to the human? Does our role in the market shift from making the calls to just asking better questions and designing even smarter systems? Now that's a thought to carry with you. Thanks for joining me.